Hello. Today I'm joined by George Ensor, who's the fund manager of the River and Mercantile UK Microcap Investment Trust. George, you invest in the very small end of the UK stock market, companies that are listed on AIM. Could you briefly run through the size of companies that you invest in and the qualities that you like to see in a business?
On the size piece, we look to invest in companies with a free float market cap below 100 million. We tend to use a soft barrier at the bottom of 20 because deploying capital below that level is very difficult. So there are about 450 stocks listed in the UK in that universe, and we're looking to own about 40 stocks, so quite a concentrated portfolio. And we run our winners out of the top. So there isn't a threshold where we need to sell those stocks, and we'll run them as they grow. Hopefully they get more liquid and they re-rate, and we can benefit from that. So that's the size piece. On the qualities, we've got our investment philosophy at River and Mercantile, which is called PVT, potential valuation and timing. We're looking for companies with the potential to create shareholder value, so that's fundamentals. We're looking to buy them cheaply, valuation, and with supportive timing. And we look for EPS momentum, excuse me, and technical momentum for timing. So within the trust, we bias towards quality and growth as the two forms of fundamentals. And I'd say 75% of the trust is invested in these, and probably put that into two buckets. One would be early stage growth companies where we see very high levels of revenue growth, but returns and margins are depressed by a high reinvestment rate. These businesses reinvest to continue driving the top line, and then as those businesses mature, the reinvestment rate drops away, and we see margins and return on capital improve. And I'll put that in the kind of second bucket of kind of quality growth stocks. So if you were to look at the biases we've got in the fund versus our benchmark, the kind of factor tilts, we've got a big factor tilt to growth, companies that have grown sales and EPS higher than the market average. We've got a small tilt to value and quality. So on average, our stocks are higher quality, a bit cheaper than the benchmark, and show considerably higher growth.
Why is it that other fund managers tend to overlook shares that have a market capitalisation of less than 100 million?
So I guess the first point is that it's a very small part of the market. So our benchmark is the Numis Smaller Companies benchmark. That's the bottom 10% of companies listed in the UK, and that tops out at about 1.9 billion. So we're looking sub 100. So I haven't done the maths, but you're looking at perhaps less than 1% of the market cap of listed businesses in the UK. So it is a very small part of the market. And the second point is it's extremely illiquid, and it's difficult to deploy capital and take capital out of these stocks. We overcome that by being in a closed-ended investment trust. We don't need to worry about daily flows. And the second element to the trust, which we do, is we return capital to shareholders when the trust gets too big. So this is something we've done 5 times since IPO. We originally raised 70 million of capital. We've actually returned 77 million of capital and have an investment trust left of circa 110. So that combination of keeping the trust the right size and having it closed-ended means that we can invest in these very small companies and take, relatively high conviction stakes in those businesses.
I now wanted to drill down into the portfolio. What have been the standout winners for the trust in the market recovery phase that has taken place since last April?
So if I look at the performance from the market loads, the NAV is up about 150%, and that's circa 35% outperformance. There has been one standout outperformer in the fund that has delivered a decent portion of that, and that's Maxite. Maxite's business we've had high conviction position in for quite a long time. We actually added to that position in a placing in Q2 of last year. Maxite licenses an enabling technology for cell therapy companies. That's an industry that's undergone significant growth over the last few years. The catalyst for the re-rating of that business was actually in that placing to high-profile life sciences businesses were brought to the share register, and the company announced that they were looking to list on NASDAQ, which is something that they have successfully completed in the last couple of weeks. So that was the standout performer. We also rotated the portfolio from relatively defensive to a bit more pro-cyclical through Q2 and Q3 of last year. DX Group was a business we had owned prior to the crisis. It got sold off quite aggressively. We added to that position its UK logistics business. I think the performance of that from the lows was over 300%. And we participated in some of the placings for businesses that had stressed balance sheets. So Joules, the clothes retailer, and City Pubs both came to market, and we invested in both those stocks. We've made circa 200% on Joules, over 100% on City Pubs. So that rotation into more consumer domestic cyclical businesses certainly helped, and that was enabled by us having being quite defensively positioned in Q1, and actually our drawdown versus the market in the first quarter helped returns for last year, but it also enabled us to get on the front foot and be a bit more aggressive with putting capital to work into these at the time recovery investment cases.
Looking ahead, could you name a couple of companies that you own that are looking undervalued and are ripe for a potential re-rating in their share price?
So I've touched on our philosophy. We're looking for fundamentally strong businesses. We're looking to buy them cheaply, and we're looking to buy them with supportive timing. So the concept of buying businesses where earnings upgrades should drive re-ratings is part of our philosophy. So most of our holdings I should be able to make a strong case for. But if I look in our top 10, our largest holding post Sigma Capital being taken private is Science and Sport. Science and Sport owns two brands in the sports nutrition industry, Science and Sport itself and PhD. That's a business that trades on about 1.5 times sales. A private label competitor got taken private recently for 2 times sales, and Grenade, who are one of the other big brands, got taken private, got bought for 4 times sales recently. So I think there's clear re-rating potential there. InStem is a software business we have in our top 10 that trades on 11 or 12 times EV/EBITDA. It's a business with a high level of recurring revenue, improving margins, above average revenue and profit growth. So I think that's a relatively cheap, high quality business. And then the final one I'll probably say also in our top 10 is Litigation Capital Management. So this is a litigation funding business, quite similar to Burford. The challenge the markets have with these businesses is around accounting. So they use fair value accounting, and so have unrealized gains in the P&L. Litigation doesn't. They use cash accounting. So we don't have that risk around the subjectivity of accounting with Litigation Capital Management. But despite that, it trades on 1.5 times book value. So again, that's a business with a 10-year track record of exceptional returns on cases that's trading at a pretty modest premium to a very conservative book value.
I read that you participated in the IPO of CMO Group recently. Have there been any other IPOs that you've backed this year? And looking ahead, are there any potential IPOs in the pipeline that you've got your eye on that could IPO before the end of the year?
So it's been a busy year for IPOs. The capital markets have been open. We've been quite active in this fund. It's a good way for us to put capital into the market. So CMO was one. Virgin Wines was another one. Quite similar business models there. They're both e-commerce, direct to consumer. Obviously, one's wine, one's building products. Both have business models that acquire users quite cheaply, which is critical to the success in those businesses. We also invested in Supreme earlier in the year, which is a value distributor and manufacturer of value products. So 88 Vape is one of their products. So that's a high return on capital, high growth business. And we've done 2 others. ActiveOps is an early stage software business. They provide a productivity improvement to the back offices of globally distributed businesses. They pitch a 15% productivity improvement, which delivers 100% ROI. So that's a pretty compelling pitch for large businesses. And then finally, LendInvest, most recently LendInvest, which happened in the last 6 weeks or so. That's, as the name suggests, a lending business. They've taken share in the UK buy-to-let mortgage market, and they've IPO'd to raise capital to go into the specialist homeowner mortgage market, which is for self-employed people. It's another part of the market which the traditional banks don't, have struggled to compete in versus the new entrants. So those are the ones we've participated in. Looking forwards, we're in a quiet stage at the moment because everyone's on holiday, but I think come September we're going to see lots more IPOs coming. I think they're going to try and get a few more done by the end of the year. I'm not aware of any at the moment, but we'll wait to see what comes.
George, thank you for your time today.
Thank you, Carl.